warm welcome to the special edition of the Global View with me, Tanveer Gill. My guest today on the show is just the voice you need to hear in the current global markets turmoil. Koch, who's head equities at Client Portfolio Management at Goldman Sachs Asset Management, is my guest today, and she joins me for an exclusive chat. Katie, it's great to have you on the show. Thanks very much for taking out the time.
Awesome to be here.
Welcome to India.
Thank you. Incredible India.
Incredible. Are you finding things as incredible as you have in the past? This is not your first trip. You've had many trips in the past as well.
Right.
What has been the experience like this time?
We've had a fantastic trip. So just by way of background, I work in Goldman Sachs Asset Management, and we've brought 20 clients with us that are asset owners from all over the world, sovereign wealth funds, pension funds, to come to India and meet some of the leading policymakers and also corporate leaders and really try and make a determination about whether or not the country is on a good growth trajectory, and they're considering allocating long-term capital here. So we've been doing a lot of work with them to introduce them to India.
Yeah, so just to clarify for our viewers, GSAM doesn't have presence in India, but you have allocated nearly $4 billion through offshore funds in the Indian markets, which means that you have a lot of investment in some of the Indian-based, Indian-domiciled companies.
That's right. So we do have a team doing investing based here locally. So we have 7 people in Mumbai building India-dedicated portfolios. However, we're selling those portfolios to non-Indian clients. So our client base is international. We are, though, one of the largest foreign asset managers of Indian assets, and we do manage about $4 billion in Indian assets.
No, so what's been the experience like, given the fact that you've met some top industrialists as well as policymakers in the country over the course of your last few days here?
Yeah, so it's interesting because when I was in Davos a couple of weeks ago, I had the great privilege of hearing from your Prime Minister, and he said that when foreign investors come to India, they're going to see that the red tape has been cut and the red carpet's going to be rolled out, and that's absolutely the experience that we've had since we've been here. We've had the great opportunity to meet with 3 people in cabinet, including the finance minister, the railway minister, and also the transport minister. And I think our clients were incredibly encouraged by the vision and the leadership of the government. And what we heard from them is that we're obviously aware of the many reforms that have been announced so far. We spent a lot of time better understanding GST and the impact on the economy, demonetization, what we've done in infrastructure. Clients are really encouraged about what has been announced. And what we heard from government is that in the next couple of years, the focus is really going to be on execution. And they gave some specific examples of how they were going to be focusing on that execution. I think clients were really encouraged about what they heard from the policymakers here in India.
Enough to convince them to incrementally allocate more capital to India through GSAM?
Yeah, I think our clients are definitely leaving more positive about the Indian economy and more positive about the corporate space in India being able to translate that superior GDP growth into great earnings.
You talked about the budget, and you've come at a very interesting time,
yeah,
Katie.
Absolutely.
First things first, the LTCG issue.
Yes.
The long-term capital gains tax. As an FII, as somebody who's routing a lot of money into India, what's the feeling like? I mean, what's the initial response?
Right. So long-term capital gains tax didn't exist before. Now it's 10%, as you know. 0 is always better than 10%, but in the very...
The government is calling it a concessional rate.
Right. And actually, like in the very grand scheme of things, I would say a few things. The first is that we and our clients are long-term investors. So we are looking to make tremendous wealth creation over many, many years. So a 10% tax on exit for what we hope to be a very big gain is not going to dissuade us from investing in this market. The second point I would make is that it's bringing India in line with other international markets. One of the very few markets that didn't charge a long-term capital gains tax, in line with other markets now. And the third thing would be maybe this is actually quite a smart thing to do from a fiscal perspective, and I think it is good for the government to take in more revenues. And as we said, we're very confident in the leadership here, and we think that they'll take those additional revenues and spend them in a productive way for the economy.
That's interesting. So this doesn't deter you from reconsidering allocations to India, right?
No.
You still have a very strong overweight position.
Absolutely. We do. So we're overweight India in the context of our global emerging market portfolios, and many of the clients that are here this week are looking to increase EM allocations, but also possibly to India specifically.
You also spoke about the fiscal situation, and now that was a bit of a disappointment again that came through in the budget. Well, there are 2 camps in the market. One believe that, the government should have pretty much stayed on course of meeting the fiscal deficit targets laid out earlier, but they're going to go past those targets by a few 30-40 basis points odd into next year. Is that much of a disappointment, or do you think that that's fine as long as growth is strong for the economy?
So I would say, in the context of the last 5+ years, I think foreign investors have been encouraged about the fact that there's been much more fiscal responsibility. So we certainly want to see the government stay on that path. The deficit increase they're talking about, though, it isn't huge, as you said. It's less than 0.5% of a point. And again, we think that they're doing it for good reason, for long-term investment. So we'll watch that. We still think that the government is acting in a fiscally responsible way. We'll continue to monitor that. But we think it makes sense in terms of the context of the much larger plans that they have, and we're not particularly worried about it.
The Indian equity markets, let's talk about that, because that's core to your overall EM strategy as well.
Absolutely.
How do you look at Indian equities compared to EM equities in the current market environment? Because last year was such a fantastic year. It was like a rising tide lifting all boats, so everything went up.
Yeah.
But do you think that there's still more upside given where valuations are? India in the context of EMs and EMs in general?
Yeah, so for foreign investors, when they look at emerging markets, let's start there, they're getting about 2 times the earnings growth at a 25 to 30% discount than what's on offer in U.S. equity markets, right? So EM at a headline level looks more attractive to the U.S., more earnings growth, and you get to pay less for it. So that looks quite attractive. And then within emerging markets itself, India actually is one of our favorite places to allocate capital. Now, I do think that India has the capability of outperforming many other emerging markets, but our overweight we built up more at the company by company level, because one of the great things about the Indian equity market as an equity investor is the diversity of the market, that there are so many privately run companies. So we try and avoid state-owned enterprises, and this market has less state-owned enterprises than China, for example, so many privately owned companies and great diversity across a lot of different sectors. And so when we're building our portfolio company by company and going down in the market capitalization, India is the place where we find the most idiosyncratic and interesting opportunities, and that leads us to be overweight India in the portfolio.
What fascinates me the most is that you have $4 billion parked in small caps and mid caps in India.
Yeah.
Right, where we've seen a fair amount of unwinding over the last few weeks, but they have done well against the benchmark.
Right.
They've done well against the large caps,
Yeah.
right? Is the conviction likely to take you to extend your allocation to large caps as well, or do you think that India is a small cap, mid cap treasure house?
Right. So we do always invest across the market cap spectrum. So we do have some large cap companies, but we are overweight the small and mid cap companies relative to most of the major benchmarks. And I would say that we've been able to generate outperformance when small and mid caps have been in the lead, and we've also been able to generate outperformance when they've been behind. So really the track record that our team has built, led by Hiran Dasani, is really built through the stock selection that's been persistent through different market environments and through capitalization of the market taking different leads. As it relates to your question, are we going to change that? No, I think we're still going to run a balanced portfolio with a bias towards those small and mid-cap companies because they're less covered by the sell side. People are just not as aware of those opportunities, which means there's more inefficiency there and more opportunity for alpha generation. And we tend to be able to find more of these companies linked to the story we're most excited about in India, which is the rise of the middle-class consumer.
So is consumption your large play?
Yeah, we definitely have a lot of links in the portfolio to consumption and related sectors, to the consumer, like education and healthcare, for example. We do have some exposure to infrastructure build through the materials sector, but I would say our largest play in the portfolio is through consumer and consumer-linked stories.
Right, and that's important because the focus for India has been consumption for a very long time.
Yeah.
But now attention is being laid on how the next leg of growth will come in through the investment-led cycle,
Yeah.
right? Which is infrastructure essentially, and most of your clients have been talking about that. You
Yeah.
said that your clients are very keen. You
Yeah.
in fact met the Maharashtra Chief Minister as well in this regard to talk about.
Absolutely.
I mean, look at Mumbai, right?
Yeah.
It's all dug up. Hopefully, by the next time you come into the city, it'll be a lot more developed in terms of infrastructure. But you think that's a big theme?
Yeah, across all of India, and certainly what we heard from the Chief Minister of Maharashtra today is that there's a big commitment to making infrastructure spend here, and they're going to get funding from the domestic market, but they're also looking for foreign investors to commit to it too. So infrastructure, no doubt, at the state level and at the federal government level is going to continue to be a focus. It's just about finding the companies at the right valuation that are linked into that story for us as investors.
And I just want to understand from you, so what have you picked up with regards to the Indian infrastructure story? Because we've been calling for capital for a very long time,
Yeah.
right? And those commitments have not really come through.
Yeah.
What are you seeing on the ground change? And may I also add that there are very few quality companies out there which have good execution capabilities, right? but the demand is significant.
Yeah.
So how do you bridge the gap, and what are you seeing on the ground change for your conviction to build in the sector and for you to get clients to invest?
Yeah, so I think that the infrastructure here is going to be built by a combination of foreign companies, and there are some domestic companies here that have good execution track records. So I think that you're going to get a combination of foreign financing. I think you'll get some local financing. I think there's a lot of banks that are going to be interested in providing financing to the infrastructure build out of India. And as long as it continues to be a priority stated by the federal and the central government, which is certainly what we heard when we were in Delhi, and that the states are focused on executing in it, I think that the capital will come and the resources will be deployed.
Right. So enough, you think, to take India's growth story to beyond 8%, or do you think 7.5% in this sort of a global environment is realistic?
Okay, so when we're in the U.S., we're happy to get 2.5%. So with you guys at 7.5%, I think that's quite good.
But the bases are very different, right?
That's 100% true. But you know, in the 7 to 8% range is probably the right target, because of course, you know, if you get so much higher than that, you start to get inflation issues. I think it's, you know, the demographics would suggest that you can maintain that 7 to 8 growth % level for many years to come, and that's probably the right spot to be in. And on the back of that, you're going to create a lot of GDP, a lot of market cap, and hopefully a lot of wealth for people here.
Yeah, you know, Katie, you are here at a very interesting time. I'm sure you must be inundated with emails over the last 2 days because of what's happening in the U.S. Give us your sense.
Yes, it's been interesting to be here when U.S. markets have dislocated.
I thought you would take the next flight back home, but you're here, which is a sign, right?
It is absolutely a sign, because we're really focused on the long term, and this is absolutely part of our long-term strategy, emerging markets in India specifically. So what we've seen in the U.S., I think, is typical late cycle behavior. We're getting some normalization and volatility, and one might argue that needed to happen, and that's a good thing. And markets are jittery because they're worried about a rate rise. And why is there going to be a rate rise? There's going to be a rate rise because growth is good in the U.S., and with growth comes inflation, and with inflation, the central bank needs to act and raise rates. So I think you've seen people kind of trying to get their footing and repositioning, but I don't think it's a major crisis situation. I think we'll work our way through it. All of that being said, we continue to believe that some of the best opportunities in equity markets are actually outside of the U.S. We've been saying that for quite some time, and so we've been encouraging clients for the last few months to reduce U.S. exposure and allocate more internationally to both developed and emerging markets.
Because I told my viewers that your voice matters, and yours is the voice that they need to hear right now. Goldman Sachs has said that this is a correction. This is not the start of a bear market.
Right.
That's the conviction that you hold. You know, we might go down in the near term, but things will reverse soon.
Right. I would say I think my colleagues on the sell side have put out some notes on that, and again, I would agree with that. Late cycle behavior, correction. We don't think that this is the start of a major bear market. We don't think that U.S. equity markets are in a bubble either. But you know, again, we do see better relative opportunities for equities outside of the U.S.
But this is a Super Bowl market, right? It's run 10 years.
360 some %. Yes, absolutely. So listen, but you used this term before, so I'm going to appropriate it again. It's the base, right? It's the base that you're coming from, and we came out of one of the greatest crises in financial history. So I would say this: sometimes people look at U.S. equity markets and they say, "Is this a bubble?" Because valuations are in the 99th percentile on most metrics, right? And so on the one hand, that's actually a little bit unnerving how expensive markets are. But then on the other hand, two things: one would be that growth continues to be good, and the second would be, while valuations are a necessary condition for a bubble, they're not the only condition. The other really important thing that you need is investor euphoria. And while, to your point, markets have run a lot, one thing that's interesting is if you look at retail flows into U.S. equity markets, they're actually 100 billion negative since the crisis. So while business sentiment is quite positive in the U.S., investor sentiment really never got to the point of euphoria. So I don't think we're at a bubble moment in the U.S. I think what we're seeing is a correction, and again, typical late cycle behavior, but the opportunities for us continue to be more outside of the U.S. than in the U.S.
But give us your sense on how the inflation picture looks like in the U.S. because that's the premise on which the Fed might change their outlook.
Yeah, absolutely.
Right now, I think 3 rate hikes are par for the course.
Right.
But do you think?
We actually think Goldman thinks that there'll be 4 rate hikes, and the market has more or less pricing in 2. So.
Oh, okay. If that assumption plays into with what the treasury yields are doing, which is closing towards 3%, which is always seen as a risky zone, right? What would that mean for the reversal to get worse from here? I mean, what would that mean for growth to not pick up to peak levels of 3.5%. Even sustaining 2.5% annual growth is becoming a bit of a challenge in the United States.
Yeah, so I mean, we'll obviously have to monitor inflation really closely, but in this I have some good insights because, of course, we manage equity portfolios all over the world and we deal with corporates all over the world, and so we have some insights into wages, for example, which are very, very important for thinking about inflation. And you've seen some minor pressure on wages, but nothing that suggests to us that we're going to see a dramatic pick up in inflation. We actually expect it to be relatively measured. So again, when it comes to rates, it's going to be slow. It's going to be coming from a low base, and it's going to take some markets time to digest it, but we don't think it's going to be entirely dislocating.
The other angle to inflation is oil prices.
Right,
how much can that derail the story?
And very important for this country in particular,
yeah,
right?
Yes,
so
true.
I would say it is clearly, if we had at the same time wages picking up and then we also had a major re-rating in commodities, that would be very challenging for most global economies to accommodate. The view from Goldman Sachs is that we're not going to have a doubling in oil price or something like that. We do think we're on somewhat of an upward trajectory, but we don't think, again, that it's going to derail this. Now, I'm also not I'm not an oil expert, so I can't predict for you with precision what I think the spot price is going to be at the end of the year. We do think it's trending higher, but we don't think it's going to get to the point where it dislocates this.
The other concern with this sell-off has been, the parallels that one has been drawing on a technical basis with the Black Monday in 1987, October 1987. Do you think those parallels, those comparisons are justified?
Right. So, well, the magnitude's obviously at this point very different because we had a 4% drawdown in one day, and that was probably 5 times as much in October. So I think it's a little bit too early to draw those comparisons. But certainly there's a technical component in here as well.
The other trade that I wanted to highlight that's played out over the last few days is what's happening with bond yields, right? They're spiking, prices are tumbling, and there's just been this sense that money is moving out of equities into bonds. How do you explain that move? How do you explain that trade?
So when you have dislocation in the markets, people flee for safety, and bonds are perceived to be more safe than equities, so people will sell equities and buy bonds. But on a longer term perspective, like very big picture here, we have a world where growth is going to be good. That should be supportive, first and foremost, of equity markets. When growth is good and inflation rises, which you've asked about a few times, central banks will raise rates, and that means that fixed income is going to underperform. So our very big picture view here is that we like equity over credit and credit over rates. In an environment where 15% of the world's debt is in negative yield territory and rates in many parts of the world are going to go up, we would prefer equity as an asset class over debt. And while people may make different short-term behaviors, long-term equities to us still looks much more attractive than credit markets or sovereign debt markets.
And within that, EM equities is preferred to DM equities.
Yes, absolutely.
On the liquidity aspect, so fine, rates are going to go up in the US. I think the concern also comes in from the fact that slowly and steadily, because growth is coming back in Europe, the Eurozone growth prints have been fairly encouraging, that inflation might be a risk there. We've already seen UK hike rates because, their inflation is overshooting the target, the target laid out by the Bank of England. I think some of that has happened in Asia as well with some of those key markets here. Would that really, in a way, arrest the revival in growth that we're seeing after a really long time? All this optimism around global growth coming back, would that arrest that pickup?
Yeah, so listen, I think that actually this is a great global growth environment. So the U.S. was really leading the way for many years, so I think it's terrific that other economies now are contributing more to global growth. And we believe at Goldman Sachs that global GDP for this year is going to end up slightly above 4%. So that's one of the best periods of global growth that we've had in a number of years. And more importantly, we think it's going to be synchronous. So I just want to emphasize that point again, that you're going to have, for the first time, all major regions and countries of the world pulling in the same direction, basically probably in about 12 years. We haven't had that. And in fact, Christine Lagarde said at Davos a couple weeks ago that this was going to be 2018, the year where we have the least number of countries in recession in the history of the IMF reporting that. So that is actually really good news about global growth. Now, you're asking about inflation. Well, yes, the byproduct of good growth is that you are going to get some inflation, but as long as we have central banks acting to rein that in. There's no reason to panic about it or believe that it can't be done in an orderly manner. Our central case is that we're going to continue to have this growth. That is actually going to be very good for risk assets, especially equities. Central banks are going to have to, in certain cases, raise rates to control inflation. That could be negative for fixed income in parts of the world, but it doesn't need to create too much fear on the behalf of investors.
Okay, what about the risk in China? Because I remember in Feb of 2016, China and commodities were the X factor that led the markets down, right? What happens with China? Because their debt to GDP is just swelling up. It's now, what, 250 to 300 times? 300% rather?
There's a lot of facts about it. It depends whether you take the government debt or you put in the private sector debt, et cetera. But very big picture, China is the world's second largest economy. So what happens there matters a lot. And we don't see the near-term possibility in China for a hard landing. We're actually pretty optimistic that China is going to continue to stay on this steady growth trajectory, which it has been on. And of course, my expertise is in equity markets. We have a lot of capital allocated to China as well. We invest in both the Hong Kong listed market as well as the A-share market. And in China, I mentioned that we like the consumer in India. That's very much what we're focused on in China too. So I would say from an investment perspective in China, you have the old China, which is about the state-owned banks and manufacturing, and we try and avoid that part of the market. We invest heavily outside of the benchmark in China, and we're really gearing ourselves into what we call the new China stories, which would be, for example, green technology, healthcare, and rise of the middle-class consumer. So we think the growth backdrop is going to continue to be reasonable, and bottom up, we actually can find a large number of companies that we like in China, particularly ones outside the benchmark.
But suffice to say that you believe after a great 2017, 2018 could be a bit rocky for the markets, and on balance, better for emerging markets than developed markets?
Yeah, I think that's a great summary. I think that we've had a long period of growth recovery in the U.S. We've had a very long bull market, as you said, so we're in the later stages. There's no doubt about that. We should expect volatility to pick up. We've experienced that in a very visceral way this week. That's probably going to continue. But there are many opportunities outside of the U.S. We've been encouraging people to allocate capital in equity markets outside of the U.S. for some time, and we would encourage them to stay the course.
And would India be one of your top 3 markets in EMs?
Yeah, absolutely. I mean, we've had an overweight position, as I mentioned, in India for a long period of time, and my time here over the last couple of days, and we still have to get to Bangalore, which we're going to go to tomorrow, but leaves me even more encouraged, really, about the long-term growth prospects here and the wealth creation potential.
And I'm so glad that you shared those thoughts with us, especially at this time. Katie, thanks very much for this exclusive chat.
It's been fun. Thank you.